Alright guys, I'm gonna be checking to see if I'm live. Well, that's pretty loud. Okay, let me check this. Sorry, it's taking a minute. I'm just confirming whether or not I'm live at the moment. Okay, yeah, so it looks like I'm live. Perfect, everybody. So welcome to good morning and welcome to Saturday's market review, where I just look at to see what I'm going to be planning on doing today is just reviewing what happened on Friday after I made that prediction of what liquidity will be used in the market for that particular session, and then just going over to see my entries to see if things were hit or not. Um, Yesterday we did go over the standard deviations of the opening range on 7:30. So just a little bit of a recap of what we were doing. We had our eyes set to the opening range pre-market, so that would be nine. I'm sorry, that would be 7 to 7:30. And I did say, where are you? Pre-market. It's from 7 to 9:30, but that first 30 minutes is very important because that low to high will be projecting our standard deviations, and it gave us like around a 1.5, 1.75, or 3/4 or whatever. And I said that if this is going to be the Judah swing of the session, we'd like to see it be used to manipulate and then be used for a later point in time. And you'll see that that's what it was eventually used to hit buy side liquidity once we had the market open at 9:30. Something else that I was pointing out to you was the low of the dealing range that was from here to this low to this high, because it was getting updated as the market was printing more prices. And I was telling you guys that the best turtle soups are the ones that are on the low of a dealing range, hence here. And it's made even stronger when it's paired with a session liquidity pool. So we had London session lows here as well. So that made it super high probability that it could be used that it could be used as to go make prices go higher, right? Because their smart money is accumulating more longs over here, and they're doing the what's it called, the offset accumulation. So they're tricking people's sell stops orders or stop orders here, thinking that's going to go down lower quickly, but they don't. Instead, they just grab out all those stops and they use it to pair up more longs and then send it higher. So that was one thing that was really awesome to see. It gave me more of a confidence to see that when you're calling things out and it happened. It's crazy. I got really excited and emotional, and it just made me have a good time. But yeah, now that happened, now we just gotta move on to see what's next. So also we're also at a time where we should be bullish because we just broke the stock market highs, so we're making new higher highs go upwards. Okay. That's the pre-market, and now that I'm at it, I wonder if there were any other entries that we could have taken here. Now, one thing I did was one thing I one thing that did make me upset was if you look at the 100 US 100 CFD contract, you'll notice that we had barely tapped it, and that's kind of like where I had set my entry. See, it was like right here, based on the low of my balanced price range theory, which was this low right here at midnight, compared to the higher low on London session. See that? But price just barely made the tap on CFDs, barely made the tap. But MAQ, it actually went down below the London sessions at that 12 a.m. low that I was telling you about. It actually did go lower than that. So that's kind of like the disparities between future contracts and CFDs. Obviously, the more accurate price action is going to come from the futures contract. But yeah, that's if you were trading, this kind of market, um, then you wouldn't have gotten triggered, or maybe you could have because it's just so low to your asking price. It just depends on the broker, but interesting. Other ways you could have gotten involved. Okay, so you missed that. Let's see if there is any opening range gaps. So we left our markings at 7 a.m. We're going to be looking at ORGs, 930s. Okay, so at 9:30 starts here. 9:30. Okay, so we dip down 28, 29, 30. Oh, right here. Here's our first presented fair value gap. Very good. Okay, you want to go open the gap, make that, and reverse it. Right, because it's a premium opening. I'm sorry, a premium high. Price dip down to the inefficiency. This is going to be treated as a busy. Okay. So it's treated as a busy. Come back down. Traded down below its low of the FVG, but then immediately it got sent upwards. So where would have been your stop loss? Your stop loss would have been here, because this fair value gap low was created by this candle's high. So you take that candle and place your stop loss here. So that would have been nice. At a time where we anticipate prices go up higher because we had that wave down to a turtle soup. So ideally the entry would have been down here. But let's say you had missed it, you could enter on the fair value gap. You would have still had to do a 40 handle stop loss and then aim to where? The buy side liquidity from the morning. That's a good one. Okay. But then where the price eventually end up going upwards. Let's see here. Amazing. So 2 3/4 RR. And you don't need that. You could have just left it up to here, 1.8. That would have been enough, right? Because we're in new market high, so we don't really know how far price is going to go up there, or do we? So that was a nice trade. And let's see, what else do we have? Let's take a look at our ORGs, see how that was reacted upon. Oh wait, hold up. There's still another one that I need to look at. And that was the one that I was telling you guys about. The opening range electronic trading hours variant. Okay, based on the Thursdays 3 p.m. close to Fridays 12 a.m. opening, right? How is that gap used? Well, you see that it had traded to consequent encouragement again, right? Because on Friday, we were looking at, I think it was Thursdays, um, and it had done the same thing where it had repriced quickly over to the consequent encouragement of this gap, and immediately just got sent to higher prices. Same case here. So the soup, consequent encouragement of the electronic gap, sent higher. Okay, trade it down right here. Okay, you could probably say there's an inverse now. And there was something here that happened, a change in the state of delivery. We'll take a look at that, see what maybe caused that, and then respecting these levels, see that low, under low, respecting that level again, it's using as stepping stones to go up higher here. Okay, so that's something else that I've been taking note on lately. Again, we weren't taught that. It's just something that I put two and two together, and that's just kind of my working theory at the moment. Let's take a look at the ORGs, how that was respected. Now this is the ORG's um, regular trading hours variant, so I just think there's too much going on here. Okay, so we have our ideal target that we were watching for a very long time, for weeks, that we got the buy side liquidity from our 7 a.m. OR range. Okay, we got 1, 2, let's take you. Okay, there you go. Done. So we have our closing on Thursday and our opening on Friday based on regular trading hours. So this is our opening range gap, and it's what we opened up higher. So that means it's a premium open. It's a premium open. That means I want to I want to see this treated as like a busy, kind of having the same kind of mechanics. So we trade it down lower from it, immediately reprice higher. And again, it was also used as stepping stones. So here, let's see if we can add some quarters into this. Quadrants, there you go. Stepping stone, the bodies, stepping stone, the wicks, stepping stone. That was our way of, I guess, it's showing support that it wants to keep going up higher. And maybe this is a market maker buy model. Who knows? Maybe on Sunday opening we wick a little, maybe to the high, and then maybe trade up higher. Right? Who knows? Possibility. We are now in new high territory, so the idea is to just keep buying this thing. Keep buying this sucker out till it starts showing a change in state of delivery. Which I think it should be coming soon because, oh yeah, let's take a look at the dollar too. But first, before we even do that, I want to look at the lunch opening range. See if there was anything that could have been caught there. Let's see here. So 11, we have 11 low. Okay, low to this high. Where is my projection box? There you are. What are you doing over there? Come over here. Whoa, I really had that thing way back. Okay. Oh, sorry about that, guys. I'm gonna see if I can probably do this to like 9:10, 9:15. Really quick live stream. Just want to see how the levels will react. So we had the low. Oops. We had market open at 11:30. Then at the 11:30 or 1 second, we probably made that low. So moving forward from that. 12 o'clock, 12 o'clock. Okay, but the real high was made up here. Now, if there's gonna be a protraction, let's see here. Okay, the body's made a low on a 1.5 standard deviation. Did we retrace from it? No, we did a little. Made upwards, sold. This look could probably be used for support. Interesting. Where is the first percentage fair value gap here? Right here, that busy. Alright, so we have here our busy, reversed, premium high, so that's a busy. Notice that, the support, and then it was met with a bunch of taps. Look at that, 1, 2, 3, 3 taps. So this is treated as a inverse fair value gap. That's what we want to see. Price not go up higher. And then on the third gap, it gave up the ghost. Boom. Order block. Fair value gap. Liquidity. Sold. Sold, sold, sold. Back to those highs. Huh. Okay. So that would have been a nice London. I'm not lunch entry. Because again, it's going against the initial condition where we're trying to look up for higher prices. So on lunch session, we want to go against that, just for a moment. That's the tractions, and then there's the 130. Okay, 130. Okay, 130. I don't see any gaps until here. Here. Yeah, but this is a little bit tricky, right? Because from this low to this high is buy side delivery. We had this little swing high form as it was going up. So this is balanced. Maybe this is not really our first presented. Neither is this one. Maybe it's this one. Okay, so I think I would consider that my first presented fair value. Discount low. So this is going to be treated as premium. So this will be a SIBI fair value gap. Treated up here. Excuse me. Should be used as a level of resistance. We barely made consequent encouragement, so this price action could dictate lower prices. Maybe. We'll take the high and the low. Whoa, we actually had a huge range. Okay, 9. Okay, right here. Two and a quarter standard deviation, probably. Oh, no, that would have been it. Interesting. See, sometimes you get these kinds of reads of just like, I don't know, this is what I'm supposed to be looking at. That's okay, I'm still learning. So trying to figure it out. That's that. So if we had a open, high, lower, higher close, the market in a higher time frame will show that as a bullish candle. See that? Open, high, low, higher close. Done. Alright, now that we had this going on, we've updated our markings. We have everything here. Let's take a look at what was happening with dollar, right? Now the dollar is still flirting with this level down here that we're trying to aim at. And maybe we'll see it on Monday or this upcoming week. We'll probably see price dip down to those levels. If that's the case, it's because interest rates have been going lower as well. Bond prices have been going up, so they're inversely correlated. And yeah, if that happens, then the dollar will still continue to lose its value. The stock market will still be seeing um, low risk conditions, so you'll be able to see buying pressure on the stock market. However, if we treat this as a turtle soup, then the dollar once again starts going up in price. Then we'll start seeing the inverse effect where interest rates should be going up higher as well. Bonds will be going down lower, and there'll be risk-off conditions for the stock market. Yep. So expect a lot of selling pressure, which could make sense too, because we've just created new highs. So what is it that we're gonna do with these highs? Are we gonna keep going higher, or are we seizing these highs so that we can deceive people and sell to those buyers, so that we can eventually go down even lower? Who knows? Only time will tell, unless you're an insider. But if we take a look at the daily, is it this the chart? This is not the chart. Shoot. Well, lucky for us, I have another chart right here. Oh, what happened? What is going on? Great. So something's the matter. It's like can't seem to touch this. Oh, I really want to show you guys something. Okay, so let's go to MNQ. Oh, don't tell me that was the problem. Yep, that was the problem. All right, so if we take a look at this charts, now this is my commodities profile, and if I look at the DXY here and then see complement of traders, we'll see that now they're interested in buying between a 6-month and 3-month plan. You have the low to high. I believe we divide that into between, see where we're at. So who knows? It could be. This could just mean that the commitment of traders from big institutions, some big banks or whatever, are interested in seeing the dollar reach down to these levels so that they can use that as sort of soup to go up where? To go up higher. And commodities, man, have been interesting to me because I've never delved in that market. I have experience in options, trading forex, futures. Um, Definitely also want to learn about other indices, and you know, there's like other indices. It's just more opportunity, you know. Just trying to find a way that fits my lifestyle trading. Um, you know, because you can trade Asia, then you can just deal with future currencies from Asia, like the New Zealand, the Japanese yen, Hong Kong dollar. What else? I think the Australian dollar. And if you're not into that, you can also trade indices from those countries as well. So we have the AS200, the Australian S&P 200 index. You have the Hong Kong 50. And I think the Japanese have one too. Japan 225. I think it's called the what's it called? I can't remember it right now. What the heck are you called? It's the Japan index. But you know, just learning about how these logic and concepts are able to work with other markets is very interesting too. I just need to set some more time into it. So that'll be a private session for myself. Just looking into it. Okay, so what else did I want to show you today? The balanced price range theory, I guess, updating the marks, right? Because once we hit 11:30, both this dealing range and this dealing range expired for me. So now I'm going to be looking forward the other half of the day. So if we have here this low to this high, and then this high, this low, higher low, excuse me, higher low to this high, that makes this whole price leg balanced. So we're seeing kind of like a what's it called, a failure swing on the stock market. So we're jumping up to these levels. And that way, as I anticipate from 11:30 moving forward, that this price range will be used as something bullish. Something bullish. But you see that it was rejected off this as support, and then we saw that first percent fair value gap during the lunch macro. That was used to sell how it was used as a premium fair value gap for price to whiplash inside there. You saw the three taps, 1, 2, 3. Third tap gave up the ghost, sold. So that would have been a good price, not a good price, a good exit to take profit on. So you would have taken the first percent of fair value during lunch, go up against the trending market, and maybe set your sights onto this low. Yep, that would have been a good one. That would have been good. Could have sold back to this old high. You could have sold a little bit more to the sessions, the PM, not here, but this is where I would have set my sights. And then the 15U, we have the low high. Oh snap! Interesting. So for the 15U, we have a dealing range here. Another form of dealing range. So for this one until 6 o'clock, we'll see price use this as a daily range. We didn't quite expand. So if we're not going to expand higher, we're going to retrace a bit. Okay, we have our A leg and our B leg. So because we trade down our A leg, I'm not going to extend this lower. Okay, I'm not going to extend this lower. And then price is going to be, I would have liked for it to see, for price to reach up back to these levels, to 21,704, and then go down lower. Or it could even react up to the, 50% and still react down lower. That would have been interesting, but we're kind of out of time at the moment. We don't know what's going to happen next week. And again, this is just the daily balance price reach theory that I've been working on. So we have to be looking at other things like the weekly. The weekly, we had this price action going on. So once we had accomplished this, we had to look back from here. Yeah, it's from this low to this high. That's a low high. Then we had this higher low, higher high. Well, it would have been irrelevant because we weren't even near those levels. So this balanced price range should be seen as support to see prices go up higher. Let me mark that here. Yeah. And that's how we would have closed the range, but it kept going up higher. Oh, so that's that. But if we take our quadrants, right, from this low to this high, anchor or fibs. Let's see here, quadrants. Uh-oh. See where price ended up going with? Made a high. And then went back down to what? Equilibrium. Which is we're taught as fair value. So it's neither expensive or cheap at this moment. See that? If we had extended this lower to this low, and divide our quadrants up even more, we'll see that now we're in a discount. So if we take this quadrant from this 25 to 0 level, divide this by 2, ending above it is premium, ending below it is discount. We'll see that we're back down to a discount level. It just depends on what you're looking at. But yeah, and what kind of type of dealing ranges do you have? Like this would be a nice type 1 dealing range where we want to see continuation for price to keep going up higher. But you also have to compare it with other markets, right? So you got this high low. Yeah. So where you need to see that cracking correlation. Either it be on a 2-hour, 4-hour, and such. Oops. Lower low. There's also the US 30. Let's see if I can add that here. Hold up. There is the YM. Yeah, this guy really sold off here. Sorry, this is just my personal notes here. So we have NQ and ES. Okay, perfect. So I'm gonna save these changes. I thought it was interesting to see how price reacted the way it did. We used the, oh yes, I think I forgot about the first presented fair value gap at the PM session. Oh no, I didn't. We said that we found a premium gap, right? Because it had a discount opening. Sold up here, treated it as resistance, and now we're consolidating here. So where price is going now? How's it gonna be behaving? Well, we just reached a higher time frame level. It's safe to say that we actually don't know. Um, looking at the market standalone, like looking at NQ and ES by itself, I do favor higher prices because we dip down into that dealing range equilibrium. So I would prefer for prices just keep going up higher. However, when you compare it with the dollar index, you see that we saw from the commitment of traders data that they're looking to buy at a very deep discount level where price was going to be used perhaps as a turtle soup. If that occurs, and the next couple of months we'll see dollar rising up in value, and that can cause the stock market to have a risk-off scenario, meaning that it'll be difficult for the market to seek new higher highs, potentially even start seeing price falter. And yeah, if that happens, then interest rates will go up higher, bonds will start losing value. So we'll start seeing some interesting plays and some good opportunities, maybe heading into the fall season. But let's take a look at the seasonal tendencies, right? So we have here the June that was recently accomplished. July tends to see heavy price action going upwards. So take that for a grain of salt. Maybe we will see a good summer month in July and August. And then September and October, we'll see what happens. I can't forecast it at this time, but um, that's just what I've been looking at, my opinion, I guess. But yeah, I'm gonna be doing some back testing today, just on my own, seeing how I can learn more about the concepts and back test some ideas and the theories that I've been working on, and just trying to see if I can get a way I can get a better read on price. But this is all I have to share with you today, and I hope you enjoyed it. Again, we just updated our markings. We saw how price was reacting at certain levels, and how it was used as stepping stones in order to make higher prices. For example, the opening range gap on the electronic trading hour variant versus the regular trading hours variant. And we compared it also with like dealing ranges and the turtle soups and the first presented fair value gaps and how they could have been used to help you find a good entry with a good stop loss so that you'll be able to get some good rewards. And we tied our profit objectives over to the lows of balanced price range theory, where we measured on the lows of how far it could have reached up to. So yeah, and all in all, we're just gonna be looking at things over. All right, so that's all I got to share with you today. Hope you enjoyed this live stream, and I'll catch you in the next one. All right, take care.